Welcome back to Wilson Weekly on the Money Mentor podcast, where the data's hot, the clearance rates are hotter, and Doc's inflation takes are officially spicier than a Sydney auction at 10 a.m. on a Saturday. I'm Rachael Howlett, your Money Mentor, here to keep Doc in line, ask the questions everyone's thinking, and make sense of a market that refuses to chill out. Doc, let's get into it. As you said, saying goodbye to November already.
Yes. Yeah, see you later, November. Last week of November, last hurrah for housing markets until the big fat guy, am I allowed to say that, comes down the chimney in about 4 weeks' time, and then we all breathe a sigh of relief and go on holidays for a month. Well, most of us, if we're lucky, I guess. But the housing market will go on holiday. That's there's no surprise there. So we've just got, I guess, another month of buying and selling. So, if you're really looking for a great Christmas present, I guess a new home would be the perfect solution to that. Or to sell your house or your unit by Christmas would also be a good present. So enough of the frivolity. We, as I said, waving goodbye to November, which means we're waving goodbye to spring. So the real spring selling season is behind us. Well, it will be in a couple of days. But the spring selling season notionally does finish at the end of the year, which will be the week before Christmas as usual. But it's been a very strong spring selling season. Lower interest rates will do that to you every time. We will be releasing our November house price report shortly, Rachael, and we will have that hot off the press for next week's Money Mentor and Wilson Weekly podcast. So that will be interesting. It's been a rollicking ride over the last 3 months for house price growth and unit price growth, and that's likely to continue over November. So a good way to finish the year is by reviewing those house prices for spring. But let's get into today's fun-filled extravaganza. My Housing Market is my brand. Every week we bring you our podcast here, Wilson Weekly, in conjunction with the good folks at Infinity with the Money Mentor podcast. We're all about bringing you the latest information on the housing market, not just prices and rents, but also the key drivers behind the housing market, And today is clearly an example of that, because we are going to look at the latest inflation data, which was released just hours ago, Rachel, and of course is very important because we have seen a breakout in inflation over recent months due to particularly to higher electricity costs. The Reserve Bank will be meeting in December, so this will play into their decision making. So it's the last real data set the Reserve Bank has in terms of determining what interest rates are going to be. We've also got an old favourite, and that's home loan data. We used to review home loan data every month, Rachel, and that was really good because it gave us an opportunity to look at what buyer types are doing in the housing market. The ABS changed track a little bit and have gone from a monthly model to a quarterly model, which is the reverse of what they've done with inflation, where they've gone from a quarterly model to a monthly model. Okay, I'm confused. I'm sure everybody else is too. But we will have a look at that, the latest home loan data from the ABS, and that's for the September quarter. And that gives us an opportunity to look at a breakdown of buyer types. So that will be a lot of fun. Looking forward to that. But firstly, we're going to look for the final week of November at the October inflation data just released. And as I said, the September quarter home loans. And as usual, the latest weekly auction results, which of course have been very important to us in our podcast this year, because every week we do get a reliable insight into what's happening generally in our housing markets as a result of those weekly auction results, which do tell us basically what is happening. And it's been another interesting week for auction results, and not a surprise, because as the year winds down, so do clearance rates start to ease. So it's the usual seasonal effect, but still a lot of auction sales going on, Rachael. So better to be a seller than a buyer at the moment in most auction markets. But as we always say, most buyers are sellers and most sellers are buyers anyway. So it swings and roundabouts depending on just which end of the seesaw you are on, if you know what I mean. So let's get started. Not good news for inflation. And we did discuss this. We have discussed this at some length, Rachael, that we expected inflation to continue to rise. The bogey is higher electricity costs. I won't be telling people anything out there, they'll all be realising that from their electricity bills, just what a tough gig that is. And we're not alone here. Most advanced economies are struggling with higher electricity costs. Australia is not unique in the sense that the transition from the carbon economy to the renewables economy is taking a little longer and being a bit more expensive than originally hoped. And the other point is that the subsidies that the government gave us, which over the past year have now concluded, well, the major subsidies concluded. There's still a subsidy running, but that will end at the end of this year. So that, of course, means that electricity prices are higher because we don't have the subsidy. So let's have a look at the data. Monthly inflation still rising. Now, annual headline inflation, and that covers all the basket of goods that the ABS count as being what we spend our income on, up to 3.8% now compared to September's 3.6%. This is the first full monthly only report from the ABS. Before we had quarterly and monthly. Now we're only getting monthly. So they've adjusted it slightly, but this is the full deal now, the monthly inflation rate, which is good at Rachael, because we can really focus now on these insights into inflation, because they are very important in terms of the Reserve Bank's decision-making for interest rates. So 3.8% now, headline inflation, up from 3.6%. Now, underlying inflation, which takes out some of the volatile elements of the basket of goods as they change from month to month. So it gives us a more stable measure, some question marks over that, but it is the preferred measure for the Reserve Bank. That's now up to 3.3% compared to September's 3.2%. Now, let's understand just a quick background. The Reserve Bank has a target for inflation. That's a part of its model for determining what interest rates should be. The target range is between 2 and 3%. Now, it's said, the Reserve Bank has said over a number of years now, since we did have that spike in inflation post-COVID, that it wanted to see a consistent period with the underlying inflation rate at around about 2.5%. So that's not just a one-off monthly or quarterly result. They need to see that over a consistent period of time. Now, they sort of got ahead of the game a little bit this year, and they cut interest rates 3 times, February, May, and August. Good news for home owners, because we've seen a really strong surge in prices as a result. We should be used to that. Always happens with lower interest rates. So if it was a little bit of a preemptive strike, I'm certainly the housing market's not complaining about that. And of course, higher house prices add to the balance sheets of households because they give you a bigger asset balance. So tick for that. But in relation to the battle against inflation, that still goes on, as we now have inflation well outside, or certainly outside the target range, not just the midpoint of the target range, which was the Reserve Bank's plan, but we're now actually outside the target range at 3.3% for underlying inflation. So we'll have a quick discussion about what that means for interest rates shortly, Rachael. But the headline result, that another rise, we predicted this, is again because we're seeing higher electricity prices, because we're comparing the prices now, which are on the lower subsidy level, compared to where they were a year ago when they were getting a higher subsidy level. So, of course, they're going to rise. So last month they were up by 33.9%, and that's a big rise, Rachael, over a year in your electricity costs. As I said, most people will be nodding their heads. Yeah, I understand that. I can see that with my latest bill. But now it's up to 37.1% increase in electricity over the past year, and that's what's pushing up inflation. On the offside of that, which is some better news, that even though we're seeing a spike in electricity costs, we're actually seeing some relief in fuel costs, which might help to offset, does help to offset those higher electricity prices in terms of the overall inflation rate. So fuel prices were, even though they increased by 1.9%, that was a lower increase than the 2.8% over the year that they increased to September. So a little bit of offsetting there, Rachael. And that's why we had just that couple of point of a percent increase in the inflation rate. But we're now starting to see another factor, which we've also discussed, Rachel, and that's rents are starting to rise again. We know with the monthly rent reports that we produce that we've seen very tight vacancy rates continuing. We haven't seen rents increasing, but we've said that really with these low vacancy rates, it's only a matter of time before rents start to rise. And maybe we're seeing the signs of that now happening. So rents were up from 3.8% over the year to September to 4.2% over the year to October. And this has been rising now for the past couple of months, Rachel. So this is a trend which we said was likely to occur with those very low vacancy rates we have in most capital city markets. And as I mentioned, that the inflation rate is now outside the target range of 2 to 3% and rising. And we would expect to see it continue to rise as the impacts of that subsidy are still not fully being accounted for going forward. So there's the data. Electricity 37.1% higher compared to 33.9%. Fuel 1.9%, an improvement on 2.8% increase the previous month. But rents continuing to rise 4.2% compared to 3.8%. And overall inflation up 3.8% compared to 3.6% outside that target range. And you can see quite clearly where we track the series of inflation rates, underlying inflation rate, that we're now obviously in an upward trend and on the rise. So that's something the Reserve Bank will obviously take into consideration with its interest rates decision. And I think this clearly means that interest rates will stay on hold at least until we start to see an improvement in inflation. But really, that will depend on lower electricity costs, or at least a stabilisation of electricity costs, Rachel. And I'm not sure that that's going to happen, certainly in the near term. But the people will now start talking with these numbers being higher about the possibility of higher inflation, higher interest rates. That's a little bit of nonsense, because I'm not sure what higher interest rates will do to stop higher inflation costs, which are due to the changing of the subsidy process. So I think the outlook is for steady interest rates, and that's, given we've had those 3 cuts this year, that's not a bad outlook, considering we still have plenty of momentum in our housing markets, and yet to see, I think, the full force of first home buyers coming into the market as yet. So when we look at oil prices, we can see how oil prices have until recently tracked inflation, lower oil prices, lower inflation. But now we're seeing the breakout as a result of higher electricity prices. So electricity has now taken over from oil as the key driver. And the data there, the oil price data there shows us we're actually continuing to fall. The oil price over November so far is averaging lower than where we were consistently over the past 4 months, Rachel. So we'll continue to see that sort of offsetting impact of higher electricity costs with potentially lower fuel costs, and this is November, and of course we will await the November results, which will come out in a month for inflation. So a little bit of balancing happening there. We just hope that those fuel prices continue to fall, so that we will get, as electricity prices likely continue to rise, some balance in inflation. And you can see there the increase in oil prices over the year to November so far is a decline of 14.5%, and that'll work its way into the inflation rate as we saw with the latest data, the October data. So the November data will be a positive force for lower inflation, despite the likelihood of higher electricity prices. And let's just have a look at that electricity price model. Rachel, you can see there electricity prices fell with the government subsidies. That's the gold bar chart down. It went in 2024 last year. And then, of course, it started to rise as through the middle of 2025, as the impact of the subsidies started to wane. And as the major subsidy finished at the middle of this year, we're seeing a spike in electricity prices. And you can see how the inflation rate, which is the black line there, is following those electricity prices upwards. And you can see now the dotted line is the target inflation model of 2.5%. We're now well above that model, Rachel. So that sort of explains it all. And just quickly, we can see the improvement in the oil price now, under $60 US a barrel, and fingers crossed that will continue. But it will provide some relief for inflation going forward, Rachel.
Yeah, wow. Taking a breath, Doc. Inflation has clearly broken out of the RBA's comfort zone again, as you said. What really jumps out is how quickly electricity has surged from 43.9% to 37.1% annually. Like we've said, you very clearly mentioned no surprises, right, with those subsidies ending, but rents also climbing. Is this the kind of inflation profile that strengthens the case for the RBA to stay on hold longer? I mean, you did say inflation was still rising. Or are we looking at conditions that could force them back into tightening mode, even with oil easing?
No, I think there's still a few question marks over the labour market, Rachel. Still quite strong, the labour market, but not as strong as it was a year ago. So they'd want to be a little careful about raising interest rates in these circumstances. I'm not sure what good that will do, particularly because we're in this transition phase from an electricity subsidy model to a non-subsidy model for electricity. So that was always going to occur. Yeah. And of course, we must ask the question now, will the government now feel compelled to give us another subsidy, and if that happens, bang, down goes inflation, because that's the real issue. And I'm not sure the government, can be controlling inflation through taxpayer funds going onwards, but it may feel it has to, because this is obviously going to have an impact on budgets. So I don't think there's any prospect, other than maybe the Reserve Bank feeling that they might have cut rates too many times this year, and they might feel there's a need for an offset. But it would be a real back step from the Reserve Bank, given their narrative over most of this year, the last couple of years, which really indicated they felt inflation was under control. And they really should have known that there was a risk here with the end of the subsidy, that we were going to see higher inflation. I'm just a little confused at why they didn't, and they continued to say, things are great, we might cut interest rates, But as I say, I think that everything's holding, in a sense, steady in terms of expectations, but we will likely see higher inflation, but I don't think that's going to activate higher interest rates from the Reserve Bank. But you can bet your bottom dollar there'll be plenty of those in the media who will be screaming that this does mean higher interest rates because it's brilliant clickbait, right? So let's hope the Reserve Bank, it'd be interesting to see the Reserve Bank's narrative in terms of their decision on interest rates when they meet in December. So, but I think they're going to be obviously a bit more negative and pessimistic about the outlook for inflation, but how that relates to the outlook for interest rates will be interesting. So we await that very interesting news in a week or so's time, Rachael. So enough of the semi-doom and gloom, I guess, a little bit on inflation. But let's have a look at that home loan data just quickly. And home loans were higher. We shouldn't be surprised at this. This is a bit backward looking, this data. It's the September quarter, which is the only data we have, but it's good that it gives us a sense of what buyer types are doing. So total home loans up 6.4% compared to the June quarter. No surprise, we've had the interest rate cuts. We know house prices are booming. We know there's a lot of activity. We can see how high auction clearance rates are. So, of course, people are borrowing more, and this is the number of loans. More people are active in the housing markets. Owner-occupiers up by 2%. I was a little bit surprised. I thought that would be higher, but nonetheless, owner-occupiers up 2%. First-home buyers up 2.3%. I think we'll get a much bigger shift when we get the December quarter numbers, which will account for the new government first-home buyer policy, which, of course, came into effect in October. So I think we'll see a big surge in first-home buyer numbers. But the real news, Rachael, was an absolute surge in investor activity, up by 13.6%. Of course, higher prices always activate home investors, and we've seen that. That's a big jump in investor lending, 13.6% over the quarter, and I would expect that to continue as well. But it is a response to higher prices. Nothing investors like more than higher prices, capital growth, And we're seeing the results of that in the home loan data. So total homes are up by 5.8% over the year. New South Wales took over from Victoria with the highest number of loans over the quarter, but Victoria was tops for annual growth. And that's not a surprise because we know that Victoria, or that Melbourne housing market, has been in revival mode for most of this year and continuing on. So there's the chart in terms of our total home loans, and we can see that rise, which is coinciding with those lower interest rates and starting to get to quite healthy numbers there in terms of the number of home loans approved. We can see there the middle chart, the middle area chart there, is investors, first home buyers and owner occupiers up marginally. We said that 2% plus over the quarter, but a big rise in investor activity, and that's really building up ahead of steam now. And again, that which is good news in a way because it means more rental properties in the marketplace, and we already discussed those very low vacancy rates. So there we go. Over the year to date versus the same period last year, investor lending up 17.6%, Rachael. So that's a very big rise in investor lending, and we would expect to see a surge with the next lot of data in first home buyer loans. New South Wales tops for home loans over the quarter, Victoria second, and Queensland still pretty strong there compared to the other major states. So it's a bit quick on the clicker there. But so home loans doing what we expected, and there would be more to come from that. But let's understand this is a 3-monthly data set, and the next 3-monthly data set will cover the very strong spring selling season.
Yeah, well, like you said, the home loans are up this quarter. No surprise. The investors, though, are really driving that surge with the 13.6% increase. We did see our first home buyers in the game as well, though. And as you said, we'll definitely see those numbers climb up. We've seen the more flexible, updated first home buyers scheme come in on the 1st of October. But, Doc, does this investor activity signal early confidence in the 2025 market direction? Obviously, we're at the end now. We're going to see what's going to happen in 2026. Or are investors simply just reacting to those tight rental conditions, increases, stronger yields, or a combination of both? I mean, we've definitely seen both this year.
Well, it's interesting, Rachael, because it does reinforce just how important capital growth is to investors. And once they see prices rising, they want to get in on the game. Yes, income's great, rents are great, that's important, but capital growth really does light a fire under investors, and we're going to see continuing capital growth. I've already previewed what's likely to happen with the November results. Another strong month, November, for house and unit price growth, and that will, again, create energy in investors who will want to continue to get into the market. And, we still have very low vacancy rates. I've already mentioned that for most capital cities, for both units and rents. So there's no problem getting a tenant. And we're now starting to see rents rise, Rachael, as we saw in that latest inflation data. And that's 3 months in a row now. We've seen an uptick in rents after a flat period. And we did predict this given low vacancy rates. So I would expect to see investors to continue to take advantage. And, of course, this is to September. So we've already done, we've got October and November to come. And October was our strongest month for home price growth in a number of years. So that, again, will play into the psyche of investors. And I would expect to see an increase in numbers again when we get the next lot of data. So let's finish off with the latest auction results, Rachael. Just starting to ease. We expect this as we move through November and into December. We always see lower clearance rates because we get more stock coming into the market, but we're also now starting to see an easing in the number of properties. So the market's sort of peaked, but these clearance rates are still reflecting, and when we look at just the number of sales, because we're still getting high numbers of auctions being conducted on a weekly basis, even though clearance rates are marginally lower, the number of sales are still very high. So there's a lot of transactions going on still out there. And we're in the wind down now with just 4 weeks remaining till the end of the year. And we will continue to see this trend. But every year we see an easing in clearance rates over the last month of the season, and regardless of sort of where the cycle is. And that's just part of that there's a lot of anxiety from buyers and sellers trying to get things done by the end of the year before the holiday close down. But as I said, auction numbers remain quite robust, and there's still plenty of activity going on there. So just look at the numbers. Sydney auction numbers down, still a big number for Sydney, 1,400 auctions. Clearance rates marginally lower. This was the lowest clearance rate for Sydney since April. But again, with that number of auctions, it means there were high numbers of sales. And again, still tracking higher than where it was a year ago, the Sydney market. Melbourne also down in terms of auction numbers. Its clearance rate just a little bit lower than the week before, but well ahead of where it was a year ago. Brisbane held quite steady around that 50% clearance rate, which always is a sign, 50% plus in Brisbane, that it's a buyer's market, a seller's market, which it still remains, even though, again, auction numbers down a little bit. Adelaide sort of bucking the trend, higher auction numbers, but again, the strongest market of all the capital cities, Adelaide, just under 80% clearance rate, and an improvement there in the Canberra market, pushing up towards 70% clearance rate in Canberra, and again, well ahead of where that was a year ago. When we look at the trends, we can see that seasonal trend has just started to ease since the early spring peaks. That's what we see every year. Rachael, as more stock comes into the market there in Sydney, same story with Melbourne, still holding above 70% over November so far. And that's a really good result when we look back a year and see it was just over 60% a year ago in Melbourne. But we know the story in Melbourne. Brisbane bucking the trend is actually rising. And we know that Brisbane market's red hot at the moment. And there's some signs there that that's going to have a good finish to the year. And Adelaide, a little bit lower, similar to Melbourne and Sydney there, but just still tracking just under 80%, the highest of all the clearance rates. And the Canberra market, same looking model as the Sydney market there, and it's come a long way since November last year, Rachael. Still not up to the Sydney results, but certainly a revival market in Canberra. If you're looking for the latest auction results, you can get the snapshot every Saturday night on my LinkedIn channel, which is Doc Andrew Wilson at LinkedIn at around 6 o'clock. And the full national report on the LinkedIn site as well, which includes the regional breakdowns for Melbourne and Sydney and the top 10 sales under the hammer for each of the capital city markets. So around about 9 o'clock Sunday mornings, you can get that on my LinkedIn channel. If you've missed the latest national report, you can scan that QR code and that will give you a PDF copy of it. So all great. Now, finishing off with the greatest giveaway as usual in property, and that's the My Housing Market Infinity Suburb Data app. You can scan the QR code there or click the link, and that will take you to the app. You need to get a password, so it's password protected, and the good folks at Infinity will inform you how to get that password for this great app, and this allows you to provides insights into what's happening on a suburb level right across Australia. Every suburb that has data is reported here, and it's updated daily. So you can filter either for price or rent, and these are asking prices. So this is telling you what agents and vendors are expecting for their properties currently in the marketplace. So it's a really good indication of current market energy. So you can filter for either price or rent. You can filter for the capital city region or the outside capital city region. We're looking here at the New South Wales Sydney region. We're looking at Blacktown as our focus suburb. You can filter for house unit or townhouse. We're looking at houses, and you can also filter for the number of bedrooms, Rachael, and we're looking here at a 4-bedroom house in Blacktown. Currently, you get just not the median asking price, but also the low and the high. So that gives you the range that the market is now expecting, as well as the midpoint and the number of properties that are for sale. And you can do exactly the same thing for the rental market. So a great thing there for landlords and prospective tenants or actual tenants to understand what the market's actually doing. So we also have the top 10 yields for each of the regional breakdowns there, which is provides you with some indication of the return on investment, the gross return on investment for rental properties. And we can see there, not only do we get the yields, but we also get the vacancy rate, the number of properties for rent and the number for sale. And there's a hot link there, which gives you a map of the actual suburb. So that's fantastic. It is the greatest giveaway in property, Rachael. And if you're wanting to make an informed decision about a property, you must have this app. And as we say, been saying now for a couple of weeks, we are going to update this app, Rachael, for next year. Very exciting, because we're also going to include the latest news. So you'll be able to get hold of the latest property news. So we're really moving into the big time. And we might look at other factors such as the top auction suburbs in every capital city as well on a weekly basis. So hang on to that. So that'll make this app even more valuable for those wanting accurate insights into the housing market in real time. So next week, November home prices, we discussed that. Also, the October building approvals will be released and the latest weekly auction results. So I look forward to seeing everybody and next week, seeing you, particularly Rachael, when we go dissect and investigate what's happening without any clickbait or hysteria in the housing market. And if you've missed this week's report, there's a QR code that you can download a PDF copy of this report. So see you later November, Rachael. And hello December, and hello Christmas, and hello New Year's Eve, and all that sort of stuff. Who would have believed?
It's gone so fast, and it's been an incredible year in property, that's for sure.
Well, it has been an incredible year.
And I really do think that we're going to still see that trending into 2026 for sure.
Absolutely.
Yeah.
Well, there's still that sense that get in before you miss out.
Yeah, exactly. Well, we're seeing that with the investor numbers as well. A lot of those investors 100%. Are already feeling that, and they're acting. So it is a good market for our investors. But yeah, it'd be interesting to see that next quarter for sure, especially with the first home buyers.
Yes. All good.
Yeah. Awesome. Well, thank you, Doc. That is a wrap on this week's episode of Wilson Weekly. Thank you, Doc, for the insights, and thank you, everyone, for tuning in. We will be back next week with the home prices, building approvals, and whatever else this wild market wants to throw at us. Until then, Doc and I will be celebrating at Infinity's Christmas party.
Wow.
So stay sharp, stay strategic, and stay with us for the truth behind the numbers. I'll see you on Saturday, Doc.
Yeah, see you Saturday.